Silver performing very well. Don't forget the 25th of September is the end of the consultation period on whether silver should be a strategic mineral of the United States. Assuming that consultation comes to an end and there's no objections, I'm guessing that as it will be a strategic mineral, they'll have to start to stockpile it. Last time the government stockpiled it, they had 2.1 billion ounces in their stockpile. That's all gone, been used on building bombs and God knows what else. But it's all gone anyway. Some of it was auctioned off. Most of the silver which is actually mined is mined in conjunction with something else like copper or gold, and therefore it's not so much the rising price of silver which caused people to mine more. It would be more a rising price of gold or a rising price of copper would perhaps boost the price of silver, and of course that's happening. Gold is going up at the moment, maybe not copper at the moment.
Gold just hit another milestone. On Tuesday, prices reached an all-time high, and the charts make it hard to miss. Zooming out to a 5-year view, the climb looks steady and relentless. Even on the 1-year chart, Tuesday stands out as the peak, with Friday's close only slightly lower, close enough to keep momentum firmly intact. That kind of setup often signals there's still room to run, and this week could bring another push upward. Silver, meanwhile, has delivered its own surprise. Breaking through $43, it's now trading at levels last seen more than a decade ago. The comparison many traders can't ignore is 2010 to 2011, when silver briefly spiked to $50. Hitting territory that hasn't been touched in over 10 years makes this rally more than just noise. It suggests a real structural shift is in play. A key date looms ahead, September 25th, when the consultation period ends on whether the U.S. should classify silver as a strategic mineral. If that designation is approved, the government would likely have to create a stockpile. The last time it did so, it amassed 2.1 billion ounces, equivalent to roughly 2.5 years of global mine supply. That entire reserve has since been sold or used, leaving the cupboard bare. Rebuilding it now would be no small task. Nearly all current production is already locked into industrial demand, leaving little extra to draw from. If policymakers move forward, it could ignite an even tighter supply squeeze in silver. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
This week, on Tuesday, gold hit an all-time record. Let's bring up the long-term chart of gold there. You can see it about there, going up and up and up like a straight line. I'll reduce that to 5 years to make it more readable. There we are, and I'll make it a 1-year chart too. Yeah, as you can see, all-time record. It wasn't quite a record on Friday, but Tuesday was the record, and we're as near as makes no difference to that record. So we're probably going to move higher in the week, I think. Silver also surprised to the upside. Over $43 now, $43.09. So that clearly is a record for many, many years. It's not been like that for maybe 10 or more years. Yeah, we have to go back to 2010, I think it is. Yeah, 2011 maybe. Yeah, 2011 was the peak when it was just below $50. Well, it obviously did touch $50 at the time, but you can't see that on a monthly chart. So anyway, silver performing very well. Don't forget the 25th of September is the end of the consultation period on whether silver should be a strategic mineral of the United States. Assuming that consultation comes to an end and there's no objections, I'm guessing that as it will be a strategic mineral, they'll have to start to stockpile it. Last time the government stockpiled it, they had 2.1 billion ounces in their stockpile. That's all gone, been used on building bombs and God knows what else, but it's all gone anyway. Some of it was auctioned off. So 2.1 billion tons is about 2.5 years mined production. So I don't know where they're going to get the silver from this time around. They certainly can't buy it in any hurry because all of the mined silver is spoken for, because the consumption of silver has for 2 or 3 years exceeded the mined supply, and all the forecasts are the consumption of silver will keep rising and the mine supply is not going to keep rising. And why is the consumption rising? Well, it's electronics. Of course, weapons as well, but most of it's going into electronics and solar panels, that sort of thing, and your iPhone and anything else which uses electricity and needs a perfect circuit will be using silver. So I think the number of electronic devices is not going to go down, and therefore I think the demand for silver will continue to rise from the industry. Silver's pretty slow to react to price rises from mine production because, first of all, it takes many, many years to bring a mine into production, maybe a decade or more. But the second problem is this. Most of the silver which is actually mined is mined in conjunction with something else like copper or gold. And therefore, it's not so much the rising price of silver which caused people to mine more. It would be more a rising price of gold or a rising price of copper would perhaps boost the price of silver. And of course that's happening. Gold is going up at the moment, maybe not copper at the moment. And if we look at the what happens when we've had rising unemployment. So remember a few minutes ago I showed you the chart. We have the unemployment rising for many months now. And I'm looking at the chart here going back all the way back to 1970s in which you can see that every time we had rising unemployment there in 1969 going to 1971, rising unemployment, recession. So the red bands are the recessions. So you can see that again in 1973-74, again in 1980, 79-80, then again in 1981-ish, again in 1990. In each of these recessions, unemployment was rising. So the recession started when unemployment started rising. And you can see it there again in 2002, and there again in 2007. We had the COVID recession, so we'll just ignore that one, but the same thing happened. And now the recession looks like it, according to the unemployment numbers, looks like it would have started a good year ago, because we've had a year now of rising unemployment, over a year. So where's the recession? Not declared. So it could well be that they'll revise the economic numbers down and declare the recession later, because every one of these recessions has looked like this in terms of unemployment, and I'm counting them 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 recessions had a pattern exactly like this, right, of rising unemployment. So I'm expecting the next number to come in and show us that we really are in a recession. Let's just have a look at what the Fed Watch is expecting for interest rates. So currently, we're now at an interest rate of 4 to 4.25. We'll call it 4.25 for simplicity. What's the expectation? Well, the expectation for the next meeting, 29th of October, is a 91.9% probability of another cut of 0.25%. So they're expecting the interest rates to be cut from the present 4.25 to 4. They'll call it 3.75 to 4 is what they'll call it. So it's coming down to 4, and there's only an 8% chance the rates will stay where they are. But then, and there's a 0% chance that they'll be cut by more than 0.25%. At least that's the way the market is thinking today. But if we step forward to how it's going to look, that's the October meeting. But we've got some other meetings coming up before the end of the year.
The labor market is showing cracks that can't be glossed over. Clive Thompson points out that the unemployment rate has climbed from around 3.3% in March 2023 to 4.3% today. That's not just noise, it's a meaningful shift. Non-farm payrolls confirm the same weakness. Back in July, Powell said he expected monthly job creation to average 150,000 in the second half of the year. Instead, the latest number came in at just 22,000. Given the steady downward revisions we've seen month after month, even that weak figure will likely be cut further. Full-time employment has also stalled. The jobs that are being reported don't translate into more people working steady, full-time hours. Job openings show the most dramatic change. From a peak of 12.25 million in March 2022, openings have dropped almost in a straight line to just over 7 million. That's nearly a 5 million reduction in available opportunities, an unmistakable contraction. Payroll data tells a similar story. Since late 2022, Most months have shown negative job growth once revisions are factored in. The initial headlines often sound better than reality, but the adjustments strip away the optimism. Rising unemployment, falling openings, and weak payrolls leave a clear conclusion. The labor market is softening, and Powell's rate cuts reflect that shift. Let's get back to the interview.
FOMC meeting, the Federal Open Market Committee meeting, and we had the press conference on Wednesday evening in which Jerome Powell announced what we expected, which was a 25 basis point cut. And we'll have a look at that on the chart here. So you can see the interest rates just dipping down here in December last year. Interest rate cut to see there this year. So we've just gone already 25 basis points. We've had 9 months. During the conference, Jerome Powell emphasized repeatedly that the labor market is cooling off and that there are increasing signs of, or rather risks to employment. And I think he's got a very good point there, because if we look at the unemployment rate, the official unemployment rate going back in time, we're going back to 1997, you can see it swings up and down, up and down, up and down. It's swinging up now, at least since I would say, since April or March 2023. The unemployment rate then, in March 2023, a year and a half ago, was 3.27, 3.25, something like that. Now it's 4.30%. So the unemployment rate has risen from, let's call it 3.3% to 4.3% in the space of a year and a half. And you see that rise there. But what other signs have we got that the economy is slowing? Well, if we look at the non-farm payrolls numbers, I'll just bring that over a bit here, ignore the COVID spike there. You can see that month after month almost, it's a bit of a zigzag pattern, the non-farm payrolls, the new jobs being created, are sliding. Jerome Powell had said previously, back in July, he said, we expect that job creation would average around 150,000 new jobs in the per month in the second half of the year. Well, we've not had the 150,000 new jobs level would be about here on the chart. So we haven't had that in the last 1, 2, 3, 4 months. As you can see, the last figure was 22,000 jobs created, if you believe that number. Anyway, that's 22,000, way below the 150,000 that he thought that we would see. So, and don't forget, they've been revising these job numbers down every month. They tend to revise the previous months down, which always makes the current month look that much better. So I rather doubt that this 22,000 positive jobs will actually end up being a positive job number. I suspect it's going to be revised downwards just to make next month's number look that much better. But we shall see. But let's look at the number of employed working full-time. Well, that's clearly stagnating. So where are all these new jobs going? If the number of people working isn't going up, yet they got all these new jobs being created, where are they? So number of people working full-time stagnated. Let's look at the number of job offers. Oh dear, that looks grimy, doesn't it? Look at that. Since 2022, the number of new job offers has been falling month after month. It's almost straight down. So it peaked, we had in 2022, in March, we had around 12.25 million jobs on offer. And that's been going down every month virtually. And now we're down to 7.2 million jobs on offer. Down from 12.25 to 7.18. That's a huge drop in the number of jobs on offer. And if we look at the number of payrolls here, this is an interesting number. You see the zero sign, the red line. That is the number of jobs. So zero is the number of jobs created. According to the payrolls number, we have got negative jobs being created almost every month for the last year, going back to December 2022. In fact, you look at that. That's net. I mean, it's the occasional month above, but most of those results show less than zero jobs created. or not less than 0 people in payrolls. So it's quite obvious that these non-farm payrolls look like they're going to be revised downwards, but that's the number the whole world focuses on. Hey, we've got a fantastic non-farm payroll number, lots of people got new jobs, great. Then next month they revise it down. Well, looking at this, there's less people in work, less jobs on offer, more unemployment. It doesn't look to me at all like we should be relying on that non-farm payroll number. Let's just have a look at this chart here. Where is it? This one. That one we're looking at. You can see much more clearly the number of job offers falling off a cliff there. And as you can see on the chart here, they're showing another cut in interest rate, another 0.25% to 3.75%, which we call 3.5 to 3.75. The chance of that happening is 78.6%, with a 20% chance roughly of the 3.75 to 4, and only a 1% chance that it will still be where it is today. According to these numbers, we see a high probability of a rate cut in October and a high probability of a rate cut in December. That's what the market is pricing in at the moment. Those numbers, of course, can change. But it does look very much like we're going to get 2 more cuts in interest rates in the USA before the end of the year. Well, let's go and have a look at the stock markets now. Here's the Dow Jones Industrial Average. As you can see, it just hit an all-time record this week. Been accelerating to the upside in the long term. I'll perhaps look at the 5-year chart. But yeah, there you are. That's an all-time high. And I'll look at the 5-day chart just so you can see exactly where the high occurred. In fact, yes, it was clearly here. That's the all-time high. And it was on Friday, the 19th, the day before yesterday. But let's have a look at the S&P 500. Another chart, all-time record. That was up 0.5% on Friday. And NASDAQ was up 0.7 on Friday to, guess what, an all-time record. Another reason is the US money supply, which has been on the rise. M2 is rising. So with more money coming into the system, there's money out there for people to buy things. And the third reason is the increasing levels of government debt. So as the government runs a deficit, that means it spends more money than it collects in taxes. That's a deficit. As it runs the deficit, it has to borrow the money to pay for its spending. It's like, it's like a credit card. If you spend more than you collect in salary, you have to borrow the difference. So effectively, the government is borrowing the difference of what it spends more than it collects in taxes, and that's running to the tune of about 2 trillion a year. That's a pretty big number, by the way. I won't explain how big it is, but it's just really, really big. So it's needing to borrow around 2 trillion a year. So as it borrows, the government gets poorer because the government owes the money, but someone else gets that money. So someone else, or everybody else, depending on how you look at it, gets richer. And clearly they're not buying government bonds, so they have to buy something. And what do they choose? They choose asset classes of all descriptions.
Momentum in precious metals is colliding with weakness in the broader economy, and that mix could shape the next chapter for investors. Gold's relentless march to new highs signals trust shifting away from traditional financial anchors, while silver's surge toward levels not seen in over a decade suggests its role is expanding beyond industry alone. At the same time, employment data is revealing a slowdown that rate cuts alone may not be able to mask. Together, these trends point to a landscape where scarcity and economic fragility fuel demand for hard assets. The pressing consideration now is whether policymakers act quickly on strategic designations and fiscal adjustments, or whether the market itself forces a repricing that changes the balance of power between paper assets and tangible stores of value. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.